It has the potential to create widespread effects on the entire economy. It can erode consumer confidence, leading to a reduction in employment opportunities, diminished wages, and a decline in stock prices. If implemented excessively and hastily, it has the capacity to push economies into a recession. And so with that, the question arises, why are central banks increasing interest rates? Let's begin with the fundamentals. When you borrow money, you're obligated to repay a slightly higher amount to incentivize the lender. This additional amount is known as the interest rate. Therefore, when securing a loan, it's preferable to have a lower interest rate, minimizing the total repayment. Now, if your aim is to save money, a higher interest rate proves advantageous because it allows you to earn more on your savings. Consider it a reward for keeping funds in your account. However, the extent of this reward is contingent upon the prevailing circumstances. In the economy, there isn't a singular interest rate. Instead, there are myriad banks determining their individual commercial rates. However, these rates are collectively influenced by the interest rate established by the central bank. A central bank functions as a bank for other banks, just like how individuals use saving accounts. Similar to people earning interest on their deposits, banks also earn interest when they keep money with the central bank. Commercial banks maintain reserves comparable to their cash on hand. They lend these excess reserves to each other at an interest rate and can also deposit surplus reserves with the central bank, earning an interest rate in the process. Although the interest rate on excess reserves is not directly accessible to ordinary people, it still has an impact on them. When central banks increase interest rates, their primary goal is to manage inflation, the rate at which price increase for the general population. Central banks such as the Fed, the Bank of England, or the European Central Bank aim to achieve an inflation target of 2%. Interest rates indeed represent a potent tool for central banks in managing inflation. When inflation is perceived as excessively high, central banks raise interest rates. This adjustment permeates the financial system and serves to slow the pace of inflation. The mechanism works like this. When a central bank increases interest rates, commercial banks tend to earn more on their reserves. Consequently, there's a possibility that they could profit more by keeping their funds in the central bank rather than lending them out. To incentivize lending in the face of this, commercial banks may choose to elevate their interest rates, ensuring that the lending activity remains worthwhile for them. The impact of these changes on consumers varies depending on the economic context. Let's consider mortgages as an example. In countries like Finland or Australia, a significant number of individuals have mortgages with variable interest rates. If you have a variable rate mortgage, where the interest you pay is tied to the central bank's interest rate, an increase in interest rates will probably result in higher mortgage costs. This in turn reduces disposable income for households, leading to decreased spending. As households spend less, businesses become cautious about raising prices, contributing to lower inflation. In countries like United States or Canada, a larger portion of mortgages are set at fixed rates. While individuals with fixed rates are shielded from the direct impact of interest rate hikes, they still experience an indirect effect. Elevated interest rates make new mortgages more expensive, potentially causing a decline in house prices. This decrease in property values can make homeowners feel less wealthy, prompting reduced spending, which further contributes to lower inflation. The impact extends beyond consumers, as businesses may also tighten their financial belts in response to these economic shifts. When interest rates rise, businesses faced increased expenses for borrowing and investment, resulting in a decline in overall economic activity. This situation has the potential to lead to a reduction in job creation accompanied by lower wages, ultimately impacting household income negatively. Such circumstances can have adverse effects on consumer confidence, potentially causing a decrease in spending. Individuals contend with a decline in real wages, reflecting a decrease in their purchasing power. The increase in interest rates tends to slow spending, investment, and overall economic activity. In a broader perspective, this economic slowdown induces businesses to be more cautious about raising prices, contributing to a contraction in inflation. The cause and effect relationship seems to be quite straightforward, doesn't it? But the trick is knowing how far you should go. In 1981, the Federal Reserve, the central bank of the United States, permitted interest rates to reach a staggering 19%. While this move successfully stopped inflation, It also resulted in widespread economic hardship. Effectively managing inflation without significantly harming economic activity is a challenge. In the United States, more than 70 years have passed since they successfully brought inflation down from over 5% without triggering a recession. A little inflation is fine because it keeps the economy running at a reasonable pace. However, persistent high inflation poses a significant challenge. When prices remain elevated, employees typically seek higher wages, increasing costs for businesses. This upward pressure on wages can contribute to a cycle of rising prices, creating a potential spiral. For example, retail inflation in India has surged to 7.8%, presenting serious challenges for the country's economy amid subdued economic activity. Central bankers are particularly concerned about managing inflation expectations. If they can establish credibility in consistently acting to bring inflation back to a target of, say, 2%, there might be less need for frequent adjustments in interest rates, avoiding a seesaw pattern of raising and lowering them. However, raising interest rates to curb inflation can have its drawbacks. It's like applying a brake to the economy, but this action comes with a delay in seeing the full impact. The effects of interest rate changes may take as long as 2 years to fully manifest, and predicting the future remains challenging for central banks. Central banks face the dilemma of deciding whether inflation will naturally subside or if intervention is necessary. Even when central banks make accurate predictions, there is a risk of unintended consequences, potentially leading to economic downturns. Despite the somewhat blunt nature of raising interest rates, it remains a primary tool for central banks to control inflation. Central bankers acknowledge the pain associated with slowing down the economy, but argue that it is a worthwhile trade-off. The goal is to achieve low and steady inflation, providing long-term stability where inflation is not a constant concern. Well, that's about it for today's video. If you found this video helpful, do consider liking it and subscribing to the channel. Thank you so much for watching, and we'll see you on the next one.